Hello and welcome to this XPS Pensions update where we are considering longevity. Over the last 20 years, the life expectancy for an average person in the UK has increased from 77 to 81. However, this is very much a story of two halves, and from 2012 onwards, the observed rates of improvement have significantly slowed. The effect of this is that as updates to longevity forecasts are released, a typical pension scheme funding level will have improved. And alongside this, there has been an unprecedented increase in buyout activity. This all goes to show there is more to longevity risk than first meets the eye, and why setting assumptions on life expectancy can be challenging. In this video, we will explain the key elements of longevity risk, and most importantly, what you can do to manage it.
It is possible to break down longevity risk into three key parts. Firstly, there's base risk. This comes about from the limits of how well we can define the scheme's membership based on what we know about them. If we liken this to a weather forecast, say, it is equivalent to knowing which day and which part of the country you're looking at, so you can focus on the forecast that's relevant to you. Even if the forecast is right for Scotland on Saturday, this is no good if you are in fact in Cornwall on Sunday. Secondly comes trend risk, or how much longer we are going to live than our parents. This is a bit like trying to forecast the future effects of climate change on the weather. It's very challenging and subject to countless variables. And thirdly, idiosyncratic risk, the risk that just through sheer luck, your scheme's membership happen to live longer than the average. This is like the weather forecast being correct for the region as a whole, but wrong for some of the towns and villages in that region. So that sums up pure longevity risk, which impacts what you actually pay to your members. There is also a fourth risk, known as measurement risk, which doesn't actually relate to how long people live, but rather how our estimates change over time, and therefore scheme liabilities. It's a bit like how the weekend weather forecast changes as the weekend approaches. The forecasts change, but it's still only in mid-week, and it will probably change again.
Whilst hedging longevity has historically been viewed as expensive, this is very much changing. As schemes have de-risked and the insurance market has become more competitive with new innovations, we are seeing record levels of activity in terms of managing longevity risk. It is therefore vitally important to look at the various sources of risk and your options to manage them. Only then can you plan the right approach for your scheme's circumstances.
So how can we build longevity into overall risk management? We've illustrated one approach with some historic scenario analysis on a scheme that's considering two different investment portfolios. One that has a higher return, including equities, and the other with a lower risk, cash flow driven investment approach. For this scheme, the higher risk investment strategy largely overshadows the impact of changing longevity assumptions. However, if there are means to reduce longevity at little cost, this will still be beneficial. Whereas the same longevity risk combined with a lower risk portfolio is far more significant. Here it will be important to look closely at the options to directly reduce this risk. So it's clear that as an investment return target reduces, longevity rises up the priority list.
We hope we have given you an overview of the key elements of longevity risk and how to consider it. There's a wide range of solutions out there, ranging from direct methods such as buying in through an insurer or using a longevity swap, through to indirect methods too, such as member options. The most important thing is to be on the front foot, because as schemes de-risk, the longevity issue will only ever become more significant. That's it from us. If you need any help with getting to grips with longevity, please do get in touch.